So Dave, you've been incredibly active in the net lease space these past few years. Can you touch on some of the most recent closings that you've had this past quarter?
Yeah, thanks. So despite turbulent market conditions, we've been getting creative to push deals over the finish line. Our last three closings over the past 30 days included a single-tenant Burger King up in Newark, Ohio, a sale-leaseback opportunity with Scooters Coffee in Louisville, Kentucky, as well as a cannabis dispensary in Chicago that was leased out to a local family-ran business called Nature's Grace and Wellness.
I'd love to hear a little bit more about Nature's Grace and Wellness and how it was working with that new concept of retail.
Yeah, it was an exciting deal to work on. A recurring client of ours was in a 1031 exchange and had an alternative investment fall through, unfortunately, on day 45 of his identification period. So within 24 hours, my partner and I were able to identify this upleg property and ultimately had the pleasure of representing both the seller, who was a developer of the site, and the buyer in this transaction.
I'm curious what challenges you were able to overcome with the closing of Nature's Grace and Wellness.
Yeah, sure. So Nature's Grace definitely presented some hurdles. First, there's obviously inherent risks with investing within the cannabis space overall, as it's still not legal at the federal level. As a result, it's highly tied to volatile government rules and regulations that are not yet fully established within a space that's arguably still in its embryonic stage. That said, this leaves plenty of room for opportunity as the industry grows and leaders emerge within the market, which our client saw in this opportunity. So one of the main challenges most commonly associated with cannabis leased assets is obtaining financing. In this case, our client intended to close all cash, but he needed to utilize leverage in order to meet our seller's expectations and pricing on this. So we were able to creatively structure the deal to satisfy both parties involved, utilizing seller financing, which I think is an extremely useful and underutilized tool given the current market conditions. So I think we're going to be seeing a lot more of that in the coming months.
Interesting. So can you tell us how this would compare to a different sector or concept such as Scooters Coffee, for example?
Yeah, sure. I'd say ultimately Scooters Coffee was an easier deal to work through. So for Scooters Coffee, we structured a sale-leaseback deal for an operator based in Louisville, Kentucky, in order to unlock capital tied into the real estate. So this was a new development site that we ran our formal marketing process on a few months prior to the actual delivery of the site itself. But the investment offered a 20-year absolute triple net lease with annual escalations. And we ended up closing the deal with a 1031 exchange buyer that was based in California, who paid about 15 basis points off the initial asking cap rate. We were able to achieve a far more aggressive cap rate here despite the smaller franchisee credit. And I think that's for a couple reasons aside from our marketing process. The first being that QSR leased assets are outperforming the greater market in terms of demand. They're typically lower price point deals, so that lowers the barrier to entry and making them attractive to more unlevered buyers who are less concerned about turbulence in the debt markets. And secondly, Scooters is a rapidly growing tenant within an explosive coffee retailer space. Though they don't have the credit strength of a Starbucks or a Dutch Brothers or a Dunkin', they typically sign attractive long-term triple net leases with rental escalations throughout the base term. So those are extremely important to investors, especially in a high inflationary environment. And the appreciation in rental income also provides investors a better position down the road for an exit strategy, ultimately being able to ideally sell at a higher value. I think the last thing I'd touch on here is that despite upward pressure on cap rates, sale-leasebacks are going to continue to offer business owners a more attractive cost of capital in many instances, as opposed to traditional financing and I expect activity in this space to continue to grow throughout the year.
Amazing. Thank you for giving us a little insight into that. Now, do you have any parting words that you would like to leave us with?
Yeah, I think some parting words from me would be that it's no secret that overall transaction volume is down in Q1 this year, mainly as a result from hike in interest rates, turbulence in the financial markets, and continued disconnect between pricing between buyers and sellers. But given the current market conditions, I think it's more important than ever to be speaking with a commercial advisor regularly to stay abreast of market trends and activity. So we're providing clients with real-time data and getting creative to push deals over the finish line. So if you're an owner of net lease assets and seeking advisory on investment sales, sale leasebacks, 1031 exchanges, or financing within the space, don't hesitate to reach out.